The moment your income starts to rise, everything around you begins to shift in subtle ways. At first, it feels harmless. You're no longer stressing about bills, you're not checking your bank account before every purchase, and for the first time, money starts to feel like a tool instead of a limitation. That's where lifestyle inflation quietly begins. It doesn't show up as one big decision, it shows up as a series of small upgrades that feel completely justified in the moment. You move into a slightly better place because you want more comfort, you start ordering food more often because your time feels more valuable. You upgrade your phone, your wardrobe, your daily habits. None of these decisions feel reckless on their own. In fact, they feel like natural progress. You worked hard, you're earning more, so why not improve your quality of life? The problem is that these small increases in spending stack on top of each other, and before you realize it, your monthly expenses have doubled without a clear moment where you decided to double them. At the same time, your definition of normal starts to change. Things that once felt like luxuries become expectations. A basic car no longer feels good enough. A budget vacation feels like a downgrade. Eating out occasionally turns into eating out regularly. And because these changes happen gradually, you don't notice how much your baseline has shifted. What used to feel like success now feels average, and what used to feel like average now feels like a step backward. As your spending increases, something else happens that's even more dangerous. Your financial flexibility starts to shrink. Even though you're earning more, you're committing more of that income to fixed expenses, higher rent, higher car payments, subscriptions, memberships, lifestyle costs that repeat every single month. And the more fixed expenses you take on, the harder it becomes to adjust if something changes. Your income might be higher, but your ability to pivot becomes lower. Then the status spending begins to creep in. This one is less about comfort and more about perception. You start to notice what other people in your income bracket are doing, the cars they drive, the places they go, the brands they wear, and without realizing it, you begin to align your spending with those signals. Not because you necessarily want those things, but because they represent where you think you're supposed to be. You might buy a more expensive car than you need, not for its functionality, but for how it makes you feel when you drive it. You might choose a luxury apartment not because it improves your daily life significantly, but because it reflects a certain image. You might spend more on clothes, watches, or experiences that signal success to others, and the tricky part is that none of this feels irrational. It feels like you're stepping into a new level of life. The issue is that status has no ceiling. There will always be someone with more, someone spending more, someone living at a higher level. And if your spending is tied to keeping up, it becomes an endless cycle. You're constantly adjusting your lifestyle to match a moving target. And every time your income increases, your expenses rise to meet it, leaving you in the same financial position you were in before, just at a higher scale. Another layer to this is social pressure. As your income grows, your environment often changes. You might be surrounded by people who earn more, spend more, and normalize higher levels of consumption. What once seemed excessive now seems standard. And when everyone around you is living a certain way, it becomes harder to justify not doing the same. You don't want to feel left out, you don't want to seem out of place, and slowly your spending adapts to fit your surroundings. What makes this even more complicated is that lifestyle inflation doesn't just affect big purchases. It affects your daily habits. Better restaurants become your default. Convenience becomes a priority. You start paying for things you used to do yourself because it saves time or effort. Individually, these decisions don't seem significant, but collectively they create a lifestyle that requires a high level of income just to maintain. And that's where the real risk shows up. When your lifestyle depends on a high income, your margin for error disappears. If your income drops, if your business slows down, if something unexpected happens, you don't have much room to adjust. You're locked into a certain level of spending that feels necessary, even if it's not. At the same time, your ability to build wealth starts to stall, because no matter how much more you earn, you're not increasing the gap between your income and your expenses. And that gap is where wealth is built. If your income goes up by 50%, but your expenses also go up by 50%, your financial position hasn't really improved. You're just operating at a higher level with the same underlying structure. There's also a psychological shift that happens with higher spending. The more you spend, the more you justify spending. You start to believe that your lifestyle is the baseline you deserve. Cutting back feels like losing progress, even if it's the smarter financial move. And that mindset makes it harder to make disciplined decisions because everything is filtered through what feels comfortable rather than what's actually beneficial long term. Another subtle effect is how lifestyle inflation impacts your goals. Early on, your goals might be focused on saving, investing, building something meaningful. But as your lifestyle expands, those goals can take a backseat to maintaining your current standard of living. Instead of asking how to grow your wealth, you start asking how to sustain your lifestyle. And that shift in focus changes your entire approach to money. Status spending adds another layer of complexity because it's driven by external validation. The value doesn't come from the item itself, but from how it's perceived. And because perception is subjective and constantly changing, it's impossible to satisfy. What feels impressive today might feel ordinary tomorrow, and that pushes you to keep upgrading, keep spending, keep chasing a level of recognition that never fully arrives. The combination of lifestyle inflation and status spending creates a situation where your financial decisions are no longer based on necessity or long-term value. They're based on habit, environment, and perception. And the more those factors influence your choices, the harder it becomes to step back and evaluate whether those choices actually make sense. Over time, this can lead to a disconnect between your income and your actual wealth. You might be earning more than ever, living in a nicer place, driving a better car, experiencing more, but your net worth isn't growing at the rate it should be. And because your lifestyle looks successful from the outside, it's easy to overlook what's happening underneath. The danger isn't in enjoying your money or improving your life. The danger is in letting your lifestyle expand automatically without intention, because once a higher level of spending becomes normal, it's very difficult to reverse. What started as a reward turns into a requirement, and what once felt optional becomes something you feel you can't live without. As your net worth starts to grow, something shifts that most people don't expect. It's not just your bank balance that increases, it's your confidence. And at first, that confidence feels earned. You made smart decisions, you took action when others didn't, and you saw results. Maybe you invested early, maybe you built a business, maybe you took advantage of an opportunity that paid off. Whatever the reason, you start to believe you understand how money works better than the average person. That belief is where overconfidence begins to take root. It doesn't show up as arrogance right away. It shows up as subtle changes in how you think. You start trusting your instincts more than your research. You make decisions faster with less hesitation. You begin to assume that your past success is a reliable indicator of future results. And while confidence is necessary to take action, overconfidence removes the caution that protects you from unnecessary risk. At the same time, the world starts to treat you differently. When you have money, opportunities begin to appear everywhere. People approach you with business ideas, investment deals, partnerships, and collaborations. Some of them sound exciting, some of them sound exclusive, and many of them come with the promise of high returns. You're no longer searching for opportunities. They're coming to you. That's where the second trap begins: opportunity overload. On the surface, it seems like a good problem to have. More options mean more chances to grow your wealth. But in reality, too many opportunities can be just as dangerous as too few, because every opportunity demands your attention, your time, and your capital. And the more you say yes, the more those resources get divided. The challenge is that most opportunities don't come with clear warnings. They don't present themselves as bad decisions. They present themselves as potential wins. A new startup with a compelling story, a real estate deal that promises strong cash flow, a friend launching a business who wants you to invest, a trending market that seems to be going up every day. Each one feels like something you don't want to miss, and that fear of missing out pushes you to act quickly. You start thinking in terms of what if this works instead of what if this doesn't. You justify taking on more risk because you've seen positive outcomes before. And because you've had success, you assume you'll be able to spot good opportunities and avoid bad ones. The reality is that success in one area doesn't automatically translate to success in another. Just because you made money in one investment doesn't mean you understand every investment. Just because you built one profitable business doesn't mean every business you touch will succeed, but overconfidence blurs that line. It makes you believe your skill set is broader than it actually is. As you start taking on more opportunities, your focus begins to split. Instead of putting your energy into a few high-quality decisions, you spread yourself across multiple ventures. You're checking on different investments, responding to different people, trying to stay involved in everything at once. And the more your attention is divided, the harder it becomes to make clear, well-informed decisions. Another issue is that not all opportunities are equal, but overconfidence makes them feel like they are. You might allocate similar amounts of money or time to projects that have completely different levels of risk and potential. Because you believe in your ability to manage them, you underestimate how much due diligence is actually required. At the same time, saying yes becomes easier than saying no. Turning down an opportunity feels like you might be missing out on something big. And when you've experienced wins in the past, that feeling becomes stronger. You start thinking that the next big success could come from any direction, so you keep your options open by accepting more than you should. This is where dilution happens. Your money is no longer concentrated in your best ideas. It's scattered across multiple bets, many of which you don't fully understand or have the time to manage properly. And while diversification can reduce risk, random diversification without strategy creates confusion. You lose track of performance, you lose clarity on what's working, and you lose the ability to make decisive adjustments. Overconfidence also affects how you evaluate risk. Early on, you might have been cautious, double-checking everything, considering worst-case scenarios. But as you gain experience and see positive results, your perception of risk starts to change. You begin to downplay potential downsides because they haven't happened to you yet. You assume you'll be able to react in time if something goes wrong. The problem is that not all risks give you time to react. Some decisions have immediate consequences. A bad investment, a poorly structured deal, a partnership with the wrong person. These can lead to losses that aren't easy to recover from. And when you're overextended across multiple opportunities, a single mistake can have a larger impact than it should. Another layer to this is the influence of other people. As your net worth grows, you're more likely to be surrounded by individuals who are also pursuing opportunities. Conversations shift toward investments, deals, and strategies. And while that environment can be valuable, it can also amplify overconfidence. When everyone around you is talking about wins and new ventures, it creates a sense that constant action is necessary. You might feel like standing still is falling behind, that if you're not investing in something new, you're missing out. And that mindset pushes you to keep moving. Keep allocating capital, keep chasing the next opportunity, but constant movement doesn't guarantee progress. In many cases, it just increases exposure to unnecessary risk. There's also the issue of complexity. The more opportunities you take on, the more complicated your financial life becomes. Different investments with different timelines, different risk profiles, different requirements. Keeping track of everything becomes a task in itself. And as complexity increases, clarity decreases. It becomes harder to see the big picture, harder to understand where your money is actually going, and harder to make strategic decisions. Overconfidence can also make it difficult to accept when something isn't working. Instead of cutting losses early, you might hold on longer than you should because you believe things will turn around. You trust your initial judgment even when new information suggests you should reconsider, and that delay can turn small mistakes into larger ones. The combination of opportunity overload creates a cycle. Success builds confidence. Confidence leads to more opportunities. More opportunities lead to more commitments, and more commitments increase the chances of mistakes. And because everything feels like progress, it's easy to stay in that cycle without realizing the long-term impact. What makes this trap particularly dangerous is that it often develops during periods of growth. When your net worth is increasing, when your income is strong, when things are going well, that's when overconfidence and opportunity overload are most likely to appear. And because the results are still positive, the risks don't feel urgent. You might not notice the inefficiencies, the unnecessary risks, or the lack of focus because they're hidden behind overall progress. But over time, those factors start to compound. The missed opportunities to concentrate on what works, the losses from poorly understood investments, the time spent managing things that don't deliver meaningful returns, all of it adds up. And eventually you reach a point where managing everything becomes overwhelming, not because you don't have the ability, but because you've taken on more than you can effectively handle. Your decisions become reactive instead of intentional. You spend more time maintaining what you've started than evaluating whether you should have started it in the first place. As your net worth grows, the financial challenges you face become less about numbers and more about behavior. At the beginning, money decisions are straightforward. Spend less than you earn, invest consistently, avoid obvious mistakes. But as your wealth increases, the decisions become more nuanced, and the biggest risks are no longer external. They come from how you think, how you react, and how you manage what you've built. One of the most underestimated traps at this stage is emotional decision-making. When you have more money at stake, your emotions become more involved, not less. Every decision carries more weight because the numbers are bigger. A small percentage loss now represents a significant amount of money, and that changes how you respond to market movements, opportunities, and setbacks. When an investment starts to decline, fear kicks in faster than logic. Instead of evaluating the situation based on fundamentals, you react to the discomfort of seeing your net worth drop. You might sell too early, locking in losses that could have recovered with time. On the other side, when an investment is doing well, greed begins to take over. You hold on longer than you should, hoping for even higher returns, ignoring signs that it might be time to take profits. This emotional cycle creates inconsistency. Your decisions are no longer based on a clear strategy, but on how you feel in the moment. And because emotions fluctuate, your actions become unpredictable. One day you're cautious, the next day you're aggressive, and over time that inconsistency erodes your results. Another layer to this is attachment. The more money you invest into something, the more personally connected you become to it. It stops being just an investment and starts feeling like a reflection of your judgment. Admitting that it was a bad decision becomes harder because it feels like admitting you were wrong, and that resistance can keep you tied to underperforming assets far longer than you should be. You start justifying why you should hold on. You look for information that supports your original decision and ignore anything that contradicts it. This confirmation bias makes it difficult to see the situation objectively. And while you're holding on to losing investments, your capital is stuck in places where it's not growing. At the same time, you might treat winning investments in the opposite way. Instead of letting them grow, you take profits too quickly because you're afraid of losing what you've gained. That fear limits your upside. So you end up in a situation where you cut your winners short and let your losers run longer than they should, which is the exact opposite of what builds long-term wealth. Taxes become another major factor that starts to influence your decisions. Early on, taxes might not feel significant, but as your income and investments grow, they become one of your largest expenses, and without proper planning, they can quietly reduce your overall returns by a substantial margin. You might make decisions based purely on returns without considering the tax implications. Selling an asset at the wrong time, not taking advantage of tax-efficient strategies, or failing to structure your income properly can all lead to unnecessary losses. And because taxes are often overlooked in day-to-day decision-making, they become a silent drain on your wealth. Time also becomes a critical resource as your net worth increases. The value of your time rises, but many people fall into the trap of trying to manage everything themselves. They monitor every investment, track every expense, and try to optimize every detail. While this might seem responsible, it often leads to inefficiency. You end up spending hours on tasks that don't significantly impact your overall financial position. Time that could be used to focus on high-value opportunities, personal growth, or strategic decisions gets consumed by minor optimizations. And the more complex your financial situation becomes, the more tempting it is to stay involved in every detail. This leads to another challenge: complexity. As your wealth grows, your financial life often becomes more complicated. Multiple income streams, different types of investments, various accounts and structures, and while complexity can offer advantages, it also increases the risk of confusion and mistakes. It becomes harder to have a clear overview of your finances. You might lose track of how different parts of your portfolio are performing. You might overlook inefficiencies or redundancies. And without a clear understanding of your overall position, making informed decisions becomes more difficult. At the same time, your original purpose for building wealth can start to fade. In the beginning, the goal might have been financial independence, security, or freedom, but as your net worth grows, the focus can shift toward maintaining or increasing that number. Wealth becomes a scoreboard rather than a tool. You start measuring progress by how much your net worth increases instead of how your life improves. And that shift can lead to decisions that prioritize growth over everything else, even when those decisions don't align with your actual goals. You might take on more risk than necessary, spend more time managing money than enjoying it, or delay important life choices in pursuit of higher numbers. There's also the influence of your environment. As you become wealthier, the people around you often change. You're more likely to interact with individuals who have similar or higher levels of wealth. And while that can provide valuable insights, it can also create subtle pressure. You might feel the need to match their level of success, their investments, or their lifestyle, and that pressure can influence your decisions in ways that aren't always aligned with your best interest. You might invest in something because others are doing it, not because you fully understand it. You might take on risks that don't fit your strategy because they seem normal in your circle. Another overlooked aspect is the balance between preservation and growth. As your net worth increases, protecting what you've built becomes more important. But focusing too much on preservation can limit your ability to continue growing. On the other hand, focusing too much on growth can expose you to unnecessary risk. Finding that balance requires discipline and clarity, but emotional decision-making makes that balance harder to achieve. Fear pushes you towards safety, while greed pushes you toward risk. And without a clear framework, your decisions can swing between the two extremes. Over time, these small inefficiencies and emotional reactions start to compound. Each decision might not seem significant on its own, but together they shape your financial trajectory. The missed opportunities, the unnecessary taxes, the time spent on low-value tasks, the emotional trades, all of it adds up. And because these challenges are less visible than obvious mistakes, they're easier to ignore. There's no clear moment where something goes wrong. Instead, it's a gradual drift away from optimal decision-making. Your wealth might still be growing, but not at the rate it could be. Your financial position might still be strong, but not as efficient as it should be. The complexity, the emotions, the shifting priorities, and the external influences all interact in ways that make financial management at higher levels more demanding. It's no longer just about making good decisions. It's about consistently making disciplined decisions in an environment where the stakes are higher and the variables are more difficult to control.